Welcome back to class. Today, we're unpacking a global financial shift that is quietly impacting absolutely everything. I mean, from your grocery bill at the local market to your long-term retirement portfolio. If you really want to understand the true state of international finance today, you've got to look past those daily stock market headlines. So, in this explainer, we're going to pop the hood of the global economy and decode exactly what the world's biggest investors are doing right now.
To understand what's truly happening, we have to start by examining a number so large it's honestly a bit hard to wrap your head around. $140 trillion. That is the size of the global bond market. Now, I know stocks usually get all the media attention, but this bond market, it's the absolute backbone of all global finance. It's the single biggest financial market on Earth, and right now it is flashing a massive warning sign that we're entering a sovereign debt crisis.
So, the central question we're exploring in today's lecture is this. What happens to the global economy when investors suddenly stop trusting that governments can actually pay this massive debt back? Because when that bedrock cracks, it creates these huge shockwaves that dictate the cost of literally every mortgage, car loan, and credit card on the planet. Here's the syllabus for today's explainer. We'll be looking at bonds and sovereign debt 101, the inflation supply chain, the global ripple effect, the household budget crisis, the Federal Reserve's trap, and finally, defending your retail portfolio. Okay, let's jump right in with Section 1, Bonds and Sovereign Debt 101. Let's make sure we have a solid foundation here so nobody gets left behind. The term sovereign just means government, so sovereign debt is really just a giant IOU from a government to pay for things like roads, the military, and Social Security. They're essentially saying, hey, give me your money today, and in 10 or 30 years, I'll pay you back plus interest. The bond yield? Well, that's just that interest rate. But crucially, the government doesn't just get to dictate this rate, the market decides it based entirely on trust. When investors feel safe, they'll accept a low yield. But right now, nervous investors are looking at government debt and demanding multi-decade high yields before they hand over a single dime. They are firmly saying, pay me more money or I am not buying. But why are these investors so incredibly nervous right now? Let's turn to Section 2, the inflation supply chain, to figure that out. Investors are sweating because the raw cost to manufacture and ship, well, everything, is skyrocketing. Physical oil has been trading above $100 a barrel, and that flows into the cost of everything else. Notice the ripple effects here? The Producer Price Index, which tracks what it costs businesses to make things, hit 6%. Meanwhile, the Consumer Price Index is sitting at 3.8%, which is nearly double the target rate of 2%. Think about it. If you hold a government bond yielding 4.5% while real inflation is surging right past that, you are mathematically losing purchasing power. You're locking your money up just to watch your wealth shrink. And this brilliantly illustrates the hidden danger here. Inflation actually has a built-in delay. Take fertilizer, for example, which is up 20%. That cost increase doesn't hit your cereal box tomorrow. It's going to take 3 to 6 months to filter through the supply chain and eventually show up on your grocery bill. Because of these delays, the massive inflation in commodities hasn't even fully hit the everyday consumer yet. But bond investors, they look 10, 20, 30 years ahead. They see this early warning signal and they demand higher yields today to compensate for tomorrow's guaranteed higher costs. Now, let's move to Section 3. The global ripple effect, because this is a deeply interconnected web, not just a domestic issue. Let's look at Japan for a second, the biggest foreign holder of U.S. treasuries. Because global finance is so deeply intertwined, we are currently witnessing this vicious doom loop. Step 1. Japan desperately needs dollars to buy oil. Step 2. To get those dollars and defend their collapsing currency, the yen, they're forced to sell off chunks of their $1.1 trillion in U.S. treasuries. Step 3. When Japan dumps U.S. bonds, all that massive new supply pushes U.S. yields higher, which ironically makes the U.S. dollar even stronger. Step 4. This weakens the yen even further, forcing Japan to sell even more U.S. debt. And with China also heavily reducing its treasury holdings, the U.S. has fewer and fewer buyers, meaning they have to offer even higher interest rates just to attract anyone. To truly grasp the massive scale of the math here, let's look at Section 4. The household budget crisis. If you treat the U.S. government like an everyday household, the picture becomes alarmingly clear. Just imagine a family that is completely 100% maxed out all of its credit cards. The U.S. government is sitting on $39 trillion in official debt, and they're adding roughly $2.5 trillion to that pile every single year. If a real family ran their finances this way, the bank would have foreclosed on them decades ago. At this point, roughly half of their incoming salary, meaning their tax revenue, goes purely toward covering this new debt before they can spend a single dime on actual services like roads or the military. The math simply does not work. When a government is trapped in this kind of impossible math, they can't exactly raise taxes or cut benefits without triggering a political revolt. So historically, they choose the invisible option. They just print more money. Look at the timeline from the 1970s. Faced with similar impossible math, the government just inflated their way out. From 1970 to 1980, the purchasing power of the US dollar dropped by 50%. Literally half of its value was silently erased. Meanwhile, hard assets acted as a shield. Gold skyrocketed from $35 an ounce to $850 an ounce. Bond investors know this history, which is exactly why they are demanding higher yields today. And that brings us straight into Section 5, the Federal Reserve's trap. It's an absolutely impossible choice for central banks today. Normally, when the economy starts to slow down, the Federal Reserve just steps in and lowers interest rates. But right now, they are caught in a brutal trap. On one hand, if they lower rates while inflation is still running hot, they're sending a message that they don't actually care about inflation. The bond market will revolt, panic sell, and yields are going to skyrocket anyway. On the other hand, if they raise rates to fight that inflation, they risk totally breaking the economy. I mean, credit card delinquencies are already climbing above 12%, and the U.S. government's own yearly interest bill on that $39 trillion debt, it has already crossed over $1 trillion. Think about this. Just a year ago, Wall Street was betting on multiple rate cuts. But look at this sudden shift from Federal Reserve Governor Chris Waller, who previously actually wanted cuts. He recently said, "I can no longer rule out rate hikes further down the road if inflation does not abate soon." The market is absolutely listening. It's now pricing in an over 70% chance of rate hikes by 2027. Central bankers are quietly shifting their tone, and the cost of borrowing money is poised to react. Finally, we've arrived at Section 6, defending your retail portfolio. For our practical lab session today, how do everyday retail investors interpret these massive macro signals to actually defend their own capital? When you compare stock dividend yields to government bonds right now, you really have to ask yourself a deeply logical question. Why on earth would you buy a historically expensive stock paying out a measly 1% dividend when you can secure a 5% risk-free yield from a government treasury bond? You are essentially paying maximum prices for minimum income in the stock market right now. But wait, as we've uncovered today, holding those government bonds is still incredibly risky if the central bank just turns on the printers to pay you back. That 5% yield means absolutely nothing if inflation runs higher. This is exactly why foreign central banks aren't hoarding bonds right now. They are hoarding gold. And nations like Iran, they're demanding fixed supply assets like Bitcoin in exchange for their oil. These assets act as a decentralized insurance policy, quite simply because their supply cannot be artificially inflated by a desperate government. And if you are still relying entirely on the stock market to save you, consider the debt-adjusted Buffett indicator. This is a metric that takes the total value of the stock market, divides it by the economy, and adjusts for federal debt. It has only crossed 100% 3 times in the last 70 years. The peak of the 2000 tech bubble, the 2021 everything bubble, and right now. The stock market is currently pricing in this fantasy that the Fed will just bail them out with printed money without any consequences. But historically proven valuation metrics, they are warning us that an incredibly painful reality check is looming. So, as we wrap up this explainer, I want to leave you with a final, critical thought to analyze for your own portfolio. If the mathematical reality dictates that your currency must inevitably be devalued just to keep the global debt system afloat, what are you holding right now that cannot simply be printed away? Take a very close look at your investments, understand these global ripples, and prepare accordingly. Class dismissed.